What if I told you that making $20 million by the time you were 25 is actually like one of the most dangerous financial situations a human being could possibly be in?
I mean, it sounds crazy, right? The outside perception is definitely just permanent financial security.
Right, exactly. We have this collective image of the ultimate American dream. You hear your name called at the draft, you step up to the podium, put on the team hat, and the blast bulbs go off.
And the narrative tells us that you are suddenly invincible.
Yeah. You sign this massive contract, and the money becomes this endless, roaring river that just flows for the rest of your life.
We tend to view extreme wealth as binary, like you were broke yesterday and today you are wealthy forever. But the reality of professional sports completely shatters that illusion.
Which is exactly why today's deep dive is going to look really closely at the math behind that illusion. Because that roaring river is actually more like, well, a garden hose that is about to be violently turned off.
That is a very accurate way to put it.
We are unpacking a fascinating piece of source material today from Davies Wealth Management. They are a fee-based fiduciary advisor located down in Stuart, Florida, and they produce a show called the 1715 Treasure Coast Financial Wellness Podcast.
Yeah, and specifically we are looking at their analysis titled NBA Career Finances, 5 Critical Stats for Your Wealth Plan.
Right. And the mission today is to show you, whether you are a corporate executive, an entrepreneur, or just someone trying to maximize your own retirement, how the incredibly compressed reality of an NBA player is actually like the ultimate stress test for everyday financial planning.
What's fascinating here is that the central problem of NBA wealth isn't actually about the size of the check. It is a terrifying, unrelenting race against the clock.
Time is the real enemy.
Exactly. When we look at standard mass market financial advice, it is built on a very specific assumption. It assumes that you have decades to earn, decades to recover from market downturns, and, decades for compound interest to do its job.
Right.
Take away that luxury of time, and the entire playbook has to change immediately.
Okay, let's unpack this. Because to really understand this reality, we have to isolate that variable of time. As fans, we watch the all-time greats playing for 15 or, almost 20 years.
And we think that is the standard.
Exactly. But the actual data tracked by the NBA Players Association paints a pretty brutal picture. The average career is only 4.5 to 5.5 years.
Wow.
Yeah, and for the median player, the guy who isn't the generational superstar, just a solid professional earning a legitimate roster spot, that window of real significant income is realistically just 3 to 6 years.
And that short duration is heavily dictated by very specific variables, too. I mean, draft position is a massive indicator.
Oh, for sure.
The lottery picks, those top 14 players selected, historically sustain their careers significantly longer than, say, a second-round pick or an undrafted free agent who is constantly just fighting for a 10-day contract.
Just trying to stay in the league.
Right. And your position on the court matters as well. Guards and small forwards generally sustain their careers longer than centers.
Because of the physical toll.
Yeah, exactly. A center has to carry tremendous mass, and they rely on explosive vertical athleticism near the basket. The sheer physics of that takes a devastating toll on their joints, meaning their earning window fades much faster.
That makes total sense.
And then hovering over all of this is the great equalizer injury history. I mean, a single torn Achilles or a ruptured patellar tendon can permanently alter a player's earning trajectory in a single evening.
So you are looking at a career that might be completely over by the time you are 26 or, 28. Let's run a hypothetical scenario based on these numbers, because this is where my jaw hit the floor reading through the sources.
Yeah, the math is sobering.
Let's take a player who retires at 30. They realistically have 50 years of post-career life to fund, and let's assume they make $20 million over a 6-year career.
Which is a huge amount of money.
To anyone walking down the street, $20 million means you buy an island and you never look at a price tag again.
It sounds like an infinite pool of resources. But let's actually run that $20 million through the real-world gauntlet.
Let's do it.
Before the player even sees the money, it is slashed by agent fees, union dues, and the staggering tax burden, which we will dig into shortly. Plus, they are living the lifestyle of a professional athlete in a major media market during those 6 years.
Right. They aren't living in a tiny apartment eating ramen.
Exactly. So that $20 million gross contract might net them less than $10 million in actual retained wealth. In fact, to be generous, let's say this player is incredibly disciplined and walks away with a clean $8 million to invest at age 30.
8 million. I
Yeah.
love this visual. Let's spread that over the next 50 years of their life.
Yeah.
If you just divide it up, that is $160,000 a year before any investment returns,
Right.
which, sure, is a fantastic salary for a normal person, but it is absolutely not enough to fund an entourage, buy up commercial real estate, or maintain the lifestyle they just got accustomed to.
Not even close.
It's like trying to fill a massive water tower that has to hydrate a whole town for 50 years, but the hose only runs for 5 minutes. If your entire financial plan rests on the assumption that the money stops forever in year 3, how do these guys even sleep at night?
Well, they manage it by making a radical psychological shift, or at least the successful ones do.
Okay, what does that look like?
The core belief you have to adopt, and frankly, this applies to any business owner selling a company or anyone experiencing a sudden financial windfall, is that wealth is only valuable when it is applied logically over time.
Over time, right.
You can no longer view yourself as an athlete earning a weekly paycheck. You have to view yourself as an institution. Your only job is converting a fast, massive influx of cash into a 50-year sustainable asset.
That is a huge mindset shift for a 20-something.
Huge. It requires immense discipline to look at a $5 million direct deposit and realize it is actually just your grocery and housing allowance for the year 2060.
Wow. Which brings us to the second biggest enemy of NBA wealth. If time is the first enemy, the tax code is undeniably the second.
Oh, absolutely.
Because that water tower we just talked about is leaking from multiple holes the second you start filling it. The sources show that an NBA player's take-home pay is typically 40 to 50% lower than their gross contract.
Yeah, the tax compression is staggering. The federal marginal tax rates for the highest brackets reach 37% in 2026.
Right.
Because an athlete's income is so heavily concentrated into just a few years, the vast majority of every single dollar they earn is pushed into that absolute highest federal tier. There is no spreading it out over 20 years to stay in lower tax brackets like a traditional high earner might do.
Here's where it gets really interesting, though. Let's talk about the jock tax. Davies Wealth Management is based in Stuart, Florida. Florida famously has no state income tax. Texas has no state income tax. So I'm reading this and thinking, if a player just buys a house, establishes their residency in Florida, and plays for the Miami Heat or the Orlando Magic, don't they just sidestep this entire state tax mess?
That is probably the single most common misconception regarding athlete finances.
Really? So they can't just hide in Florida?
No, even if a player is a bona fide resident of Florida playing for a Florida team, they still owe the jock tax.
Okay, explain that.
The jock tax is a legal mechanism where states tax athletes, and actually any traveling entertainer, based on the income earned while performing inside their state lines.
Oh, I see.
Think about an NBA schedule. They play 41 away games. They practice in other states. State revenue departments use what they call a duty day formula.
A duty day?
Yeah, so if you are a Florida resident but you spend 3 duty days in California playing the Lakers and the Clippers, California calculates the percentage of your total season spent in their state, and they tax that exact percentage of your multi-million-dollar salary.
Wait, so they are literally being taxed by the day in whatever jurisdiction they wake up in?
Exactly.
That means an NBA player might be filing tax returns in up to 20 different states every single year.
Minimum. 20 states is totally normal. And when they play in states with famously high taxes like California, New York, Illinois, those states aggressively collect their cut.
I bet they do.
When you combine those top state marginal rates with the highest federal bracket, the effective tax rate on the income earned during that specific road trip can easily exceed 50%.
The sources make this brilliant comparison between a corporate executive and an NBA player to really illustrate this compliance nightmare.
That's a great comparison.
Say a corporate executive makes $1 million a year. Over a 20 or 30-year career, they file 1, maybe 2 state tax returns a year. It's very stable, incremental, predictable growth.
Right.
But the NBA player makes $5 million, and it is shoved into 3 to 8 incredibly volatile years, and they have to file 20-plus state returns simultaneously.
And if we connect this to the bigger picture, this is exactly why mass market financial advice completely fails professional athletes. Well, a standard national wirehouse broker is fully equipped for that executive with a 30-year runway and a simple W-2 from one state. They're simply not built to handle 20-state tax compliance, jock tax apportionment, and massive income compression.
It's just too complex.
Way too complex. It requires a level of specialized tax strategy that you only get from an advisory team built specifically for multi-state sudden wealth taxation.
Okay, so the timeline is brutal, and the taxes are draining the tank before the money even clears the bank. Let's pivot to the offense. Once we accept this bleeding, how does a player actually grow their money?
Right, they have to invest.
The sources outline some highly specific wealth accumulation strategies. Let's start with the baseline, which is maxing out accounts.
It sounds incredibly mundane for someone making millions, but
Yeah.
step one is maxing out the 401k immediately. In 2026, the employee contribution limit is $24,500, and the total plan limit, including employer contributions, is $72,000.
For a guy making a $5 million salary, $72,000 seems like a rounding error.
It does, but locking that money away for tax-deferred compounding over 40 years is the absolute bedrock of generational wealth.
But 72 grand isn't going to house the millions they actually need to invest to survive for 50 years. So they have to rely on taxable brokerage portfolios.
Yes.
And the sources bring up concepts like asset location and tax loss harvesting. Let me pause you right there because I want to make sure I understand the mechanics of this.
Sure, go ahead.
When you say keeping tax-inefficient assets like bonds and retirement accounts, you essentially mean hiding the investments that throw off the most taxable income inside the 401k where the IRS can't currently touch them, right?
Correct.
And then putting the tax-efficient stuff like equity index funds in the accounts that the IRS is watching.
You nailed it. You never want to pay taxes unnecessarily during your peak earning years.
Makes sense.
If a bond is paying out regular interest and it's sitting in a taxable account, that interest is being taxed at the player's highest marginal rate, which is 37%. Put that bond in the 401k and it grows unbothered.
Okay, and what about the taxable accounts?
Meanwhile, in the taxable account, you utilize tax loss harvesting. This means deliberately selling off certain stocks that have lost value to offset the capital gains from the stocks that made money.
So it's a constant, active mathematical balancing act to reduce the annual tax bill.
Exactly. You also have to avoid unnecessary trading. High turnover, constantly buying and selling stocks generates short-term capital gains, which are taxed like regular income. You want to hold assets for over 12 months to get the much lower preferential long-term capital gains tax rates.
Okay, that makes sense. But I want to talk about the strategy in these sources that absolutely blew my mind. The Roth conversion ladder.
Oh, it is such a powerful tool.
I have always thought of Roth conversions as something people do in their 60s when they retire and move to Arizona. If an athlete retires at 30, aren't they going to face massive IRS penalties for moving retirement money around before they turn 59 and a half?
That is a very common point of confusion. There is a massive difference between withdrawing money from a retirement account and converting it.
Oh, really?
Yeah. A withdrawal triggers the early penalty. A conversion just shifts the tax status of the money.
Okay, so how does the latter work?
Let's look at the mechanics.
Uh.
The player retires at age 30. Suddenly, their W-2 earned income plummets from $5 million down to basically zero.
Right.
If they have been accumulating funds in a pre-tax 401k or a traditional IRA, those immediate post-career years offer a rare golden window. They can execute a Roth conversion ladder over 5 to 7 years.
So they do it in chunks.
Right. They take, say, $50,000 to $100,000 of that pre-tax money and convert it into a Roth IRA each year. Because they have zero other salary coming in, they pay the income taxes on that conversion at the lowest possible tax brackets.
Oh, wow. So they are voluntarily paying the tax, but because they look poor on paper that year, the tax is minuscule.
Precisely the point. They capture that low tax rate. Once that money settles into the Roth IRA, it grows completely tax-free. And when they eventually take distributions later in life, those are tax-free as well. They are securing 40 or 50 years of tax-free compounding.
It essentially turns the liability of a terrifyingly early retirement into a massive tax superpower. That is incredible.
It really is.
But it does raise a major question for me. If sticking to boring, highly optimized tax strategies like index funds and Roth conversions work so flawlessly, why do we constantly read about athletes dumping their money into buying up residential real estate or starting regional restaurant chains or funding their friends' tech startup?
Well, that speaks to the powerful psychological allure of the tangible versus the abstract.
What do you mean?
When you grow up without significant wealth, paper assets like an S&P 500 index fund do not always feel real. An apartment building feels very real. A steakhouse with your jersey framed on the wall feels real.
Yeah, I can see that.
But investing in those tangible assets requires intense critical thinking because they introduce massive risks that paper assets do not. The first is concentration risk.
Putting all your eggs in one basket.
Exactly. If you drop $3 million to open a few restaurants, your wealth is heavily concentrated in one hyper-specific sector, in one geographic area. If you own a global equity fund, you own tiny pieces of thousands of companies worldwide.
And the sources heavily emphasize liquidity risk, too.
Liquidity is paramount for an athlete. If a player's career abruptly ends tomorrow because of a knee injury, the paychecks stop instantly. But the mortgage on that apartment building, the property taxes, the maintenance costs, those don't stop.
Right, you can't just sell an apartment building in a day.
Exactly. A player cannot easily or quickly liquidate a commercial property to pay their immediate bills. With an index fund, you click a button and you have cash the next morning.
So it's much safer.
Yes. And finally, there is operational risk. Managing a business requires bandwidth, daily oversight, and industry expertise. An active professional athlete with a grueling practice schedule, media obligations, and constant cross-country travel simply does not have the time to effectively manage a restaurant chain.
So even if you avoid the restaurant trap, execute this perfect Roth ladder, and have millions sitting safely in your taxable brokerage accounts, you are still walking around with a massive target on your back.
A huge target.
How do you protect the cash once it is actually in your hands? The final piece of the puzzle here is playing defense.
This is where estate planning comes into focus and why it is absolutely not a concept reserved just for 80-year-olds.
Right, because they were so young.
An NBA player might sign a rookie contract at 19 and have a net worth of $4 million by age 22. Without an immediate ironclad estate plan, a will, durable powers of attorney, updated beneficiary designations, that money is incredibly vulnerable.
What happens if they don't have one?
If the unthinkable happens and a 22-year-old player passes away, state intestacy laws will completely dictate where that money goes. A judge who knows nothing about the player's life or wishes follows a rigid state formula.
The sources note that the 2025 One Big Beautiful Bill Act actually sets the 2026 federal estate tax exemption at $15 million per individual, or $30 million for a married couple.
That's right.
So if a player is married, they can pass down up to $30 million tax-free. That feels like it solves a huge part of the problem right there, doesn't it?
Well, the legislation does establish those concrete thresholds, which provides a very clear, factual baseline for advisors planning out wealth transfer. It removes a layer of uncertainty regarding the IRS.
But there's a catch.
For a young athlete, the federal estate tax is rarely the most immediate threat to their wealth. The immediate threat is the intense social pressure. We're talking about entourages, aggressive creditors, frivolous lawsuits, bad business pitches from friends, and even well-meaning family members asking for loans that will never be repaid.
So what does this all mean for their daily life? How do they actually build a fortress against all of that? I've always pictured a trust as just a fancy bank vault with a timer on it. What are the actual legal mechanics they use?
If we connect this to the bigger picture, they use specialized structures, like domestic asset protection trusts, or DAPTs. A trust isn't just a vault, it is a legal change of ownership.
Oh, interesting.
When a player moves money into a DAPT, they are legally transferring ownership of those assets to the trust itself. Because the player no longer technically owns the assets, a future creditor, or someone suing them, cannot touch that money.
But they can still use the money.
Yet, the trust is designed so the player can still receive the beneficial use of those funds. They also heavily utilize LLCs and family-limited partnerships to hold any physical assets, like real estate.
To keep it separate from their personal accounts.
Yes, it provides liability separation. If someone slips and falls at a rental property the player invested in, the injured party sues the LLC. They cannot pierce through the LLC to go after the player's personal brokerage accounts. And of course, prenuptial agreements. They are deeply personal and often uncomfortable to negotiate, but mathematically essential when you accumulate massive permanent wealth before you even get married.
So who actually manages all this? Because the sources make a huge point of distinguishing between a standard broker and a fee-based fiduciary.
It really comes down to legal obligations versus sales incentives. A commission-based broker at a massive national firm often has a financial incentive to sell you specific mutual funds or insurance products that generate a commission for them.
Right.
A fee-based fiduciary, like the team at Davies Wealth Management, is compensated differently, usually by a transparent fee based on the assets they manage. More importantly, a fiduciary is legally bound to act in your best interest.
Which is crucial.
When your financial timeline is this brutally compressed
Yeah.
and the margins for error are this thin,
Yeah.
you cannot afford an advisor who is treating your life savings like a monthly sales quota. You need a quarterback who is coordinating your multi-state tax CPA, your estate attorney, and your daily cash flow management under one unified objective strategy.
Let's recap the mission we have been on today. We started by looking at the terrifying math of NBA finances, trying to fund a 50-year retirement off a 5-year career window.
Right.
We looked at the brutal daily drain of the multi-state jock tax, which can push effective tax rates well over 50% no matter where you live. We explored brilliant offensive strategies, like flipping the liability of an early retirement into the superpower of post-career Roth conversions.
And the defense, too.
And finally, the critical need for defensive fortresses like asset protection trusts and legally bound fiduciary guides.
And while you, the listener, might not have a $5 million NBA salary to manage, the core principles we have unpacked today apply universally to your own life.
Absolutely.
Tax efficiency matters. Asset location matters. Protecting your retirement wealth from concentration risk, like having all your net worth tied up in your own company stock or a single piece of real estate, matters deeply.
It's all the same rules.
The NBA career isn't an alien concept. It is just life's standard financial challenges played at 10 times the speed and 100 times the volume.
It is the ultimate case study in financial discipline.
This raises an important question, though, and it is something not explicitly detailed in the spreadsheets, but it haunts almost every retired athlete I have ever studied.
What's that?
We have spent this entire time talking about the mechanical, mathematical side of crossing the financial finish line decades early. But what about the psychological toll of the financial finish line?
Let me stop you there. What do you mean by the psychological toll? Isn't crossing the finish line the whole point?
Imagine effectively completing your life's financial earnings at age 26. For most people in the normal world, spending decades climbing a corporate ladder, earning promotions, and slowly increasing their earning power provides a fundamental sense of purpose.
It gives you a reason to get up in the morning.
It dictates their daily schedule. It gives them goals. An athlete wins the financial game, but then the game is entirely closed before they even hit 30. They are placed on a strict 50-year financial allowance.
Wow.
How does a highly competitive, driven young person find their second act? How do they maintain their psychological drive, their sense of identity, and their daily motivation when the primal human need to earn a living has been permanently removed from their life?
That is a staggering thought. You step up to the podium, you put on the hat, the flashbulbs go off, and the hardest part of your life hasn't even started yet. Something for you to mull over until next time. Thanks for joining us on this deep dive into the world of Davies Wealth Management and the realities of MBA finances. We will see you on the next one.